All right, so it looks like we are live. How you doing,
Yes,
Abby?
we. Hello, hello, Chris. Happy Wednesday.
Come on, it is a good Wednesday. It's crazy that again it's like the last Wednesday of the month.
Is
This
it?
month's like normal, like the last Wednesday of the month. Like literally, I'm talking about like well, I take that back. We actually got one more Wednesday, the 31st. I'm
One
sorry.
more
So
Wednesday. Yes.
right, yeah, because I got my dates wrong. The 24th, boom. So yeah, 31st. We got one more Wednesday, but it's just crazy for me. I'm thinking about we're almost like halfway through the year, and so much has happened, and we still got a long way to go. Right?
Definitely.
Good
Definitely.
stuff. Good stuff. So you had a good weekend and everything, rejuvenated.
I did. I did. I have an amazing weekend and I had an amazing week so far.
Come on. Well, good stuff. Good stuff. One thing, well, you know what? Before I get on that, let's go ahead and open us up. So I'm Christopher Bush, financial advisor.
I'm Abby Joseph, your tax strategist.
Come on, and welcome to another episode of the Red Line Guys. Welcome to another Wednesday on the, kind of hosted by the Come Up series. We got to be a big part, right? So I would just want you to go ahead and click the like button, click the subscribe button before we get started. And back in the background, go ahead and do our intro.
That's 100. That's 100.
And we're back.
We are back, right? So let's see. Open up. Okay, so Abby, one thing I wanted to do when we get started, could you do this for me?
Of course.
I think we had a couple. Can you check? Did you check? Can you check our email real quick? I can't. I
Yes.
just check our email real quick, and I want to give everybody a chance again. This is one of those episodes that I want you guys to be really involved with, and I want you to go ahead and Vic, if you can put that on our screen, guys. Every single Wednesday, if this is your first Wednesday joining us, we want to make sure that our content, our episode is about you, the viewers. Our goal is to really give you real world information, right? And examples of different topics. Okay. And this week we have been kind of talking about, insurance topics and stuff. And I want to make sure that we kind of give you guys some real world examples so I can truly break it down. Okay. And, I want you to kind of go on our send us an email, right? On help at the comeupseries.co, right? That is help at the comeupseries.co. Please, again, bring your questions to us, right? Because that's the biggest part of our show to make us keep going is we want input from you, right? If you have questions, if you have ideas, if you have things that say, hey, look, Chris, I heard about this and I want to be able to cover it. How does that work? Okay. We want to give you guys the opportunity to have that. So, Abby, especially on your side too, right? It's big, even from a tax standpoint.
Oh, definitely. I mean, that's the goal. The goal is to be able to use you guys scenario as cousins, to use a cousin scenario, so then we can actually give you guys the best examples. So if you guys are looking into, if you guys have any tax questions or any tax code questions that, or before, if you're about to make a big purchase, one question that I had this week was I had a client that they're about to go purchase a vehicle and they wanted to go over the depreciation. One of the things that I like is when our clients reach out to us before they make a huge decision in purchasing a product. So yeah, definitely reach out to us. The best way, guys, is not to DM me on Instagram, but the best way to do so is by sending out those emails. We didn't have any emails, so we have no questions to answer, but definitely, guys, help at the comeupseries.co. Send us these questions so we can make sure that we provide you guys the best answers and service.
Good stuff. So we did have, I guess, I had a couple, had an interesting scenario that came through from one of our viewers, right? So they didn't send us an email; they actually gave me a call, right? And this one's kind of personal for me. It's it's one thing. It's one thing when you can kind of do services and help people. I don't know if you feel this
Mhm.
way, Abby, but when you can help people that you love and personally, it just hits different, right?
It does.
And sometimes, especially in our field, when you're in
Mhm.
financial services or tax or anytime when you're building a business, sometimes you would think, your friends and family, they may support you in the beginning, but sometimes those may be the last people that you actually help, right? I
Mhm.
mean, I probably help more strangers, right, that I've never known, but more than friends and family sometimes. Does that make sense?
That
Right?
makes
And
perfect sense.
right in the beginning of my career. Now it was a little bit different, right? One of my good friends, he was actually the best man in my wedding, Abby. He was
Oh,
actually the best man in my wedding. And he was kind of looking up some, again, different topics when it comes to insurance. And again, we're having an insurance month, right? So he came to me and he was, kind of talking about the infinite banking, the cash flow banking that we talked about before. And one of the things that he wanted me to look at, he said, Chris, before I do anything like this, I want you to review it. Okay.
okay.
And I said, go ahead and send me the document so we can kind of go through it and we can understand how this stuff works. Now,
Mhm.
it's pretty detailed that I'm going to cover. So I want to kind of make it not too, I want to make it digestible so you guys can ask questions, but I want you to understand the concepts that I'm going to cover. Okay. So let me kind of show this part first. And if anybody actually has, I'm just curious, is there anybody that's maybe watching the show or, that maybe watch it on a recording? If you actually have like an infinite banking, cash flow banking, bank of you type of policy, if you have one, like, I would just kind of love to see who actually has one. That's interesting. Let me see if I can do this. Let's see. Boom. That's a good question. I might put a question in there for you,
Okay.
Abby.
No problem. Marianne asked, let's pull this up real quick for her. Hey, cousins, thanks for doing this. I have a question about 1099 jobs and taxes. How do you set aside taxes so you are not overwhelmed at the end of the year? That's a very good question. To be quite honest with you, this year I had several clients that were 1099s. I had a doctor who was a contractor. I had nurses who were contractor, and a lot of individuals that are in real estate that are 1099s. So the best way, you have options, which I love. So you do have some options. Option number one would be to do what's called estimated quarterly taxes. So every quarter you pay estimated tax. So what your CPA or your accountant would do is to take your quarterly income or to project what your quarterly income is going to be. And what we will do is we will give you an amount of what that quarter you need to pay as estimated tax. Okay. Those are for my clients that are not disciplined. So my clients that are not disciplined, I usually advise them that you do need to do quarterly estimated tax. The second option that you do have is I always say that there's 4 accounts that you need to have as a business owner or a subcontractor. You need to have your profit sharing, which I use. I use STOP. STOP is your savings, your tax account, your operation account, and your profit sharing account. So you want to make sure that you do have a tax account. And in that tax account, what you would do is you would take a percentage of whatever you make, either weekly, bi-weekly, or monthly. You would deposit that percentage, you would put it in your tax account. So then at the end of the year, you're not looking at you're not surprised of your tax liability, and you have already prepared to pay for that tax liability. The reason why is because as a 1099 individual, you are paying the tax on the back end, whereas a W-2 pay their taxes in the front end. And regardless if you are a 1099 or small business owner, it is important to understand taxation as a way, as you make income, you are required to pay tax. So just like in your W-2, you got paid bi-weekly, you paid those tax bi-weekly. Who made those tax payments for you was the company. Now that you are a business owner, you are responsible to make sure that you do pay those tax. So because you have to pay the taxation in the back end, it's important for you to actually have income ready for you to pay those taxes. or you can do estimated tax. Now, to go even a little bit deeper, let's just say you are making $50,000 or more, just like my client that was making about $80,000 a year. And then I had another client that made about 300,000. And then I had another that was making $700,000. So with those individuals, and that can be you, what I would recommend is that you elect as an S Corp. So what is the electing as an S Corp helps you with? So what you pretty much tell an IRS is that, hey, listen, I would like to be taxed as an S Corp. So even though you are a 1099, I would say create an LLC, Marianne. LLC does two things for you, right? It's a protection. It protects, it's a limited liability. So it protects your personal assets. So you want to create, I would say create an LLC. And then elect as an S Corp. By electing as an S Corp, you are not taxed on the distribution, whereas under an LLC, you are taxed twice. You are taxed on federal and you are taxed on self-employment tax. That's why 1099, they get taxed so heavily. You are taxed on federal depending on where you are in the tax bracket, and you are taxed 15.3% of self-employment tax. So create an LLC, then elect as an S Corp. So then you are not going to be taxed in the self-employment area. If you are going to elect as an S Corp, I would say you need to either have your accountant, your CPA complete Form 2553 for you. I know it was a mouthful, but those are the 3 steps that I would recommend as a 1099 jobs when it comes to taxes. I hope that helped, Marianne.
That was good. Thank you, Abby, on that. That's amazing how we do that. I got all the information, and you guys are going to be really good on this on US Pacesetter. Boom. 20-year growth. Awesome. So watch this. So let's go ahead and get into it here. We're going to kind of look at the average returns on some things. I'm going to bring up our policy. This is page number. Make sure I got the page numbers right. And page numbers right. Let's see, what page number is this? Okay, I'll leave it here. All right, so we got the PowerPoint, got the share. All right. Man, come on. Let's get it going. Let's see. Like technology. Come on now, window. Okay, so I literally just reset it all. So I'm trying to pull up. Okay, here we go. I'm making sure I'm pulling up Google Chrome to pull up our presentation. Wait there.
Well, we do have a quick question while you're doing that, Chris. One of the questions that we had, someone emailed to us was, what's the best way to get a decent cost-effective life insurance policy if you have a major health issue? I currently have LI through my employer, but that's limited to X times my salary. And if I leave that company, it goes away. Also, what type of life insurance should I be looking for if I'm at age 51?
Yeah, so for the life insurance based upon your medical condition, is really, so your medical condition is going to dictate what life insurance company that you use, right? And that's the part that's huge. You need to work with life insurance is kind of like a broker that's not just working with one company, right? Especially if you have underlying medical conditions, right? So multiple different companies specialize in different types. So depending upon if it's like a illness like cancer or remember, they want to see that you're out of remission for at least 5 years minimum. Sometimes some client, they want to see at least 10 years out of remission so you can actually get a fully covered policy. If you have not been in remission for over like 10 years, no, no help, no, you may have going to the doctors, those type things, then they're going to say, okay, well, you may not get actually for a policy that's fully approved from day one. Okay. What will
Mhm.
happen? They may give you what you call a graded policy or a guaranteed issued policy, or you maybe be capped out on how much life insurance coverage you can get. It may be 25, 30, $40,000, or some companies may give you up to 100, but that may be it. Okay. So it really is really going to depend upon what type of what type of condition that you have, and then we would need to pair that up with the proper company. So with me, I work with multiple, probably over 100 plus different carriers or so. A lot of different carriers and different from disability to life insurance to auto home rent, like all the carriers. I'm able to pull a list and figure out, okay, which one fits your specific need that you would
Mhm.
like to have. Okay. But
Okay.
in the grand scheme of things, go ahead, Abby.
No, I was listening.
Yeah, so that would be the perfect way to do that. It's kind of hard to kind of give like a blanket statement, or I would actually be able to give you a real company. If you send me an email, I'll actually give you if you send me an email with your condition and you said you're 51, and then I'll
Mhm.
able to give you a real what company is best for you, and then what your coverages options look like. Right, I was actually be able to do that.
So you say if it's cancer, it's usually 10 years of remission?
We would need to see 10. Now, some companies would do it like after 5, but again, it's going to be a
Mhm.
graded policy. And what that means is this: let's say if somebody passes away in the first 2 years, they will only get the premiums back plus a rate of
Mhm.
return on the premiums that you receive. Right?
Okay.
You wouldn't actually get the full death benefit. Okay.
Wow.
Or a
Okay.
graded or guaranteed issue. So you see what I'm saying? So you want to make sure
Mhm.
you have something like that in place.
Okay. Awesome. Awesome.
All right. Any other questions that we see?
Let me see.
Yeah.
I was interested in getting a policy for myself and was wondering which policy holders you would recommend. Do we have a list of carriers that you would recommend, Chris?
Again, it's probably going to depend upon age,
Mhm.
amount of coverage, but um, it's probably it's going to be on age and age and an amount the amount of coverage. I'll probably say, but there's a lot of good ones that you can go with. Let's say if I'm looking at cheap ones, like probably Protective is one that's if we're doing term. So let's say, hey, look, we're looking at term, maybe Protective.
Mhm.
You're looking at True Stage is really cheap. You can look at um, PFS is really cheap, depending upon what coverage you have. What other coverage? What are we looking at? Pin, Pin Mutual, right?
Yes.
Um, what else? What else? What else? That was probably like some of the main ones that I would list.
Okay.
All right, that would be some of the main ones. You let's say if I get life insurance or parents not living in the U.S. Say that again.
Okay. Let me see.
That one's
This one, let's see. This one's long. So this one's is not necessarily life insurance, but okay. Um, I would like advice on rolling over money from my past employer pension account to Roth IRA. I also want to roll some of the money into my three kids' UTMA account. I have about 17,700 $79 to roll over. Lastly, Chris, you touched on life insurance plans. I have a term life policy that is little over 440,000, but it's our children that will benefit from this. So I have a question regarding how can we set up payouts to our kids if we are both gone? How can the pay the least amount of fees? Okay.
so
Can they
so say
avoid
that one. So
executor's fee, taxable court settlement costs, life insurance proceeds costs?
life settlement costs. So the first
Mhm.
thing is with life insurance, if it's a death benefit, it's completely tax free. right?
Yeah.
So life insurance is a tax-free benefit. So then if you say, hey, look, I want the life insurance to go to kids, say God forbid two people pass away, mom and dad, right? Then
Mhm.
you would, if you want to stipulate how the life insurance proceeds are going to go reach the children, that's when a trust is going to come in place, right?
Yeah,
And I think
that's what I
Abby,
was thinking too.
go ahead.
No, that's what I was thinking as well too. Correct.
Yeah, a trust would do that. Okay.
Mhm.
And for our, we're going over topics for our June topic. One of the biggest topics we'll kind of talk about is the trust. Since we're talking about insurance for this month, we want to go into the trust side probably next month a little bit, so you can understand how those two things go in place, right? A
Mhm.
couple of people have asked me previously a dynasty trust, a generational skipping trust, those type things, a living trust will. Those things are so huge on what we need in today's society, especially when we're dealing with our finances.
Okay. Let's see. Show. All right. If I pay for mentorship, is that a tax credit? If so, can you explain the tax credit and how it is applied? Okay, Louis, depending on how you are trading. So if you are trading under your social security number and you pay for a mentorship, that is not a tax credit. That is literally just a personal expense. Now, if you are trading under an entity, then it's a tax deduction. It is an expense. So if it is mentorship, it is a continuing education expense. So that's when you can actually deduct. That's when that becomes a deduction of an expense. Okay. Let me see. Next question. Can you get life insurance for a parent who is not from the USA and living overseas?
If they don't have a social security number, a TIN
Yeah,
or a TIN number,
yeah, you can. They have to have a TIN number or social security number. Okay, good questions, guys. Good questions.
yeah, y'all are doing good.
I'm guessing today's question day. All right, I would like to get another question. I guess when I say email me, you guys understood the assignment.
Come on.
Okay, let's get these questions in here for you guys. Huh? Okay, let's see. Let me have this question. Post. Let me post this question in here for you guys. You guys can see it. All right. So I would like to get a policy for my dad who is 57 and has diabetes and neuropathy. Would I need his permission to do so?
Yeah, legally, yeah. Yeah. So again, because even though that you're the policy owner of the policy, he is the primary insured, right? So what happens is that when you fill out the application, not only does the owner of the policy need to sign, but also the primary insured will need to sign as well. And again, you can't just get life
Yeah.
insurance on somebody that that doesn't give you permission to, right? So legally, you would want to have permission to get that type of policy, even if it's your parents, even if it's your child's mother or your child's father. Legally, you're supposed to make sure that you have permission to do that, right? And they should be there at the time of sale as well, right?
Yeah. Mhm. And and I'll give you a perfect example. I remember, and you guys already know my story. My parents don't believe in life insurance, so it is a discussion that my siblings and we had discussed. Should we just go behind their back and do this? Sometimes. Because something is good for someone, it doesn't necessarily mean it gives you permission to do it for them. So even though, yes, you may know that this is good, this will help, it still does not give you the right or the permission to do it behind their back. What I would say to do, I would say educate him. Right, educate him, show him the pros and the cons, be transparent with him, and allow him to make the decision with you, with the policy. I hope that helps. Can I
That was
get?
good.
Let's see. Can I get life insurance for 67-year-old parent without medical exam, and also with a medical exam? What would you recommend for the type of insurance to get?
Yeah. So wait, so say what again? The 67 and what? Hold on, let me go.
Can I get life
Oh,
insurance for
no med.
67-year-old parent
Yeah. So
without
again,
medical?
if it's they're going to ask for medical. They're going to do a medical. If they're 67, they're going to do some type of medical. Now, some policies, let's say if you do a guaranteed issue meaning they won't even do medical. However, there's going to be stipulations to that, right? Meaning that again, if they pass away in the first 1 year, first 2 years, you may not get a full death payout, right? Or again, you're going to get premiums back plus interest. So it's going to be important to understand what medical condition do they have, what pills are they taking, height and weight, all that stuff matters, and it comes to underwriting process, right? And so there's a bunch of different cases where you can get insurance coverage. 67 is really not that old, but I don't know if you would get the type of coverage that you would want. Always remember this: if somebody's as you get closer to 50 years old, life insurance premiums like almost they skyrocket, right? So
I
you
don't
know
know
it
why.
may be sometimes 67, 70 years old. It may be like $250 a month for like $25,000 worth of coverage. You know,
That's crazy.
yeah. And again, I think that's
I'll
where we
probably
have
would do
to
an S&P 500 for my life insurance then
exactly.
every
Or one
month.
good thing that we right? One good thing that we kind of talk about is I think that's why it's so important to invest because there is situations to where let's say somebody is a little bit older, they do have medical conditions, but we don't want to get life insurance or we don't want to pay that premium. Well, one thing that you can do is, if they want something that's conservative, that's going to have a floor, that's going to pay out 100% of the death benefit and not really a
Mhm.
lot of volatility with the market, we can actually do like a fixed index annuity, right? With
Yeah.
no income riders. Okay. So that'll guarantee the money, right? You'll have a floor on your investment, right? Depending upon what carrier you use in contracts, we can have a lot more upside potential, but that'll give you the death benefit that you need by taking a portion of the assets that a client already has and move that to a fixed index annuity and make their own life insurance policy for that if they have medical conditions and if they have money set aside instead of spending two, three, $400 a month on an insurance policy.
Yeah, that's actually a wonderful alternative. And for those of you that are listening, for those of cousins that are listening that are nervous or is the life insurance conversation with your parents or with your family is hard. Yes, it is a tough conversation to have, but it is a conversation that is a must to have regardless if you're going to have life insurance or not. The idea that we're not going to be here forever is a conversation to actually have. I know it's sensitive, I know it's a tough conversation. I would say make it a goal for this year for you and your family. You know, maybe it's something that we need to discuss during Thanksgiving, because now all of us are here as a family. Hey, mom, pop, there's something that, that's been heavy in my heart that I would like to discuss with you guys. It is not about our current, it's about current and future. One thing that I actually did was I went over my parents' assets. I went over all their assets. I gave them a scenario. Hey, listen, if you pass, this is exactly what would happen. So they had a picture. So try to paint a picture for them. But I understand it is a tough conversation to have, but it is a conversation that is a must to have. Okay. I hope that helps smooth with the process. Not a life insurance question, but still around 1099. Can you set up a 401k account with a 1099 income? If so, do you just contact a broker for this process?
Good question. So we just did this yesterday for a client. So if you want to set up a 401k for a self-employed person, that would be called a solo 401k, right?
Yep.
So you can do that with an advisor. Like for me, like I set up solo 401ks all the time. So literally, you just send me an email, I'll send you my calendar. I can set up a solo 401k with you. And that way that you can have a true 401k for you, right? What that allows you to do is that you can put in 22,500 as a W employee. Based on the gross income, you can do up to I think 66,500. Don't quote me. Maybe somebody can Google it real quick. Or um, um, or yeah, of the 66,500 combined. Let me make sure that's right because I don't want to be talking on Zoom and I mean on YouTube
I'll
and
take a look for you. You can continue.
right. So I think it's for total put solo 1K contributions total. So whatever the
Mhm.
difference is, so you got 22,500 is your W2 amount. Then the difference is, but of the limit, you can do a company match to that portion. However, it's only up to 25% of your gross income. Okay. So just because you make $30,000, that don't mean that you can put the whole 66,500 into the plan. Okay.
You
That
are
is
correct.
total.
It
That
is
is
six,
total.
you are correct. It is 66,000 for 2023.
Boom. All right. 66,000 even or 500.
66,000 even.
Perfect. Yeah. Good deal. So yeah, so
All
you can do that, and I think it's a good deal because think about this: if you're in that solo 401k, you can have Roth contributions, you can have pre-tax contributions, you can have company match, you can do everything that's possible. Okay, and then account, and then also you can do any type of trading strategies that you would like. For me, before I had employees, um, before I had employees, I had a solo 401k, right? So again,
right.
when I learned how to manage portfolios, I'm trading, I'm buying individual stocks. So now you can do any type of trading strategy you would like inside that 401k plan with no limit. So that's one of the benefits that I like and love.
Okay, awesome. Let's see. I can't. I come from African parents. Death talk is a. I absolutely understand love. I come from a Haitian parents. Both of my parents are from Haiti. Death talk is a taboo. It's not a conversation that my parents or my grandparents talk about. It's a no conversation. So we have been talking to my mom for years and still want to address it. I would say, try not to use the word death. I think my grandma is about to hit 90 years old. So when we talk about death with her, it's more of a transition. So I would say, I think it's literally the term that our Africans don't like. Like, I know my parents is the term. Like, to them, it's so negative. It's so, yes, Shadisha, thank you. I like that. So change the term. Have a legacy conversation. I love that, Shanisha. Thank you. Change the term. Let's just say, let's talk about legacy. Let's talk about the family. Let's talk about how this legacy looks like in the next 10, 20, 30 years. So yes, the term can be uncomfortable. So just like Shanisha said, use the word legacy. But I absolutely understand because my parents until now, they don't want to have it. They don't want to have it. And it was so funny because I had the conversation with my daughter before she left for college. I sat her down, and it was so funny because my business attorney. I had a conversation with my business attorney, and I was asking him, "What is the best age for you to have a will?" And he said, "The best age to have a will is when you turn 18. Once you turn 18 years old, you should have a will." And I was blown away. And I was like, okay. And if you really think of it, a lot of our kids, right, they leave home and they go to college and they go out of state. Some of them play sports, some of them play football. And he was giving me a scenario where a young football player got hurt doing a game and was flew to a hospital, and the mom could not see his son because there was no consent. So it's so important. So once your child turn 18, make sure they have a will. So by having these conversation, just like Shanisha say, legacy conversation, how the family looks like 20 years from now, that should help. Also express to them that you understand they don't like to talk about it. Correct. Be transparent. Be transparent with them. Be transparent with them. Yeah. The legacy conversation. You know what, Shanisha? I'm gonna try that. I'm gonna say, Ma, we need to have a legacy conversation. She's gonna be like, girl, where you going with all this gibberish?
And I think the good
In
thing,
my ears. Hmm?
no, I think the good thing is, if they present it to in a way to that help them understand that, hey, look, I've been working on my finances as well. So it's
Hmm.
not like they're just trying to get something from them, but hey, look, this is the type of person development that I've been working on myself. These are
Yeah,
things I've been learning, and this is why I'm coming to you, right?
definitely.
Just to really show
Yeah,
them that you're actually doing that work, and
yeah,
they see you growing, they see you learning, they see you with the books and attending the seminars and those type things. I think it kind of makes it a lot more welcoming to understand, okay, what really happens
yeah.
outside.
Yeah. Shanisha, we definitely need to bring you up the stage. I will reach out to you soon. Shanisha is the life insurance queen.
Come on.
Yes, you absolutely right, Shanisha. Talk about it and you understand why, but the responsibility will fall on you. And you want to make sure that you aren't a burden, and that's very important. True. Serenity, I when I was having the conversation with my daughter, she was like, Ma, is everything okay? Is there something you need to tell me? And I told her, no, there's nothing to tell you, babe. It's important. I literally went biblical with her. I was like, the Bible says, listen, a parent that prepares their child even for their death is a good parent, is our responsibility. So it is my responsibility to even prepare you for my death. So, and it's okay to have this conversation with your young ladies, your young men, if you have, especially before they go to college. Yes, proper
That's good.
preparation prevents poor performance.
That's good.
Absolutely, Shanisha. Yes, let me see if we have more questions. Since
Everybody got,
everybody now
I mean,
understand the assignment. Okay, all right. My condition, okay. Thank you for answering my question. My condition, I have kidney failure and currently in dialysis, also on the transplant list. Oh,
okay. So she wants the a carrier.
yeah. So
Okay.
so that is the same question that wanted that's 51 years old, right? And that
What
has major health issues,
what
that
did she
has
say again?
he has kidney failure and currently in dialysis and
Kidney
also on the transplant
failure.
list. Mm-hmm.
Okay, hold on. I think I have it here. So kidney failure, and
And
so
he's on dialysis.
yeah. So I would probably check. Yeah, that's going to be like a final expense type policy, probably.
Mhm.
So more than likely, like a company like Americo, Americo. That's probably one that they could probably use. Or Moo may be a decent one. Mutual of Omaha. Um, let's see. And I guess dialysis.
Mhm.
Let's see. It can be a couple. That's dialysis, I guess, would be UHL or maybe Foresters. Um, yeah, it would just again, it would really just depend, guys. On stuff like that. It's kind of hard to do it off the fly, but those are just some of the companies that I know off top that if you have kidney failure or dialysis, that will underwrite pretty well and get covered. So that's one thing I do want to say. Just because you get, let's say you go with a company or you got company before and you've been declined, right? I've had clients before say, Chris, well, I've been declined a whole bunch of times, and how you're going to be different? Well, the difference is that your other person, did they actually go through the research to find a carrier that fits you, or did they just go with their set of 3 or 4 companies that they have? So it's a, don't get discouraged about getting declined. Again, there is a way. It's just that we got to find the proper fit. Okay. I think that's like a huge key on that.
Okay, awesome. Another question that we have, this is a tax question. Let me pull it up in here for you guys. Okay, let's see. Okay. What is the best way to deal with sweat equity as a part of owner of an LLC multi-member partnership? And what scenario would it be a deductible? Okay. With sweat equity, so if you are in individuals who participate in sweat equity, you can receive a tax credit or deduction for your time and effort. Now, when it comes to a partnership, if depending on the percentage of the partnership, let's just say it's a 50-50 partnership. Well, that 50-50 would be divided on the expense. And when each of you guys receive your K1, you would be able, so let's just say the deduction is, $10,000, right? We have a $10,000 deduction and we are 50-50 partnership. Well, on that K1, you would get your 5,000, right, on your deduction to lower that your total net income, and your partner would get their $5,000. Hopefully that answered that question. Let's see. Let's see, what's the next question here? I don't know that one. I went to a seminar and scheduled an appointment with an attorney and my parents. The attorney had the conversation with my parents. Okay, you can also do that.
Yeah, yeah, that's actually really good. Just because that way it's a third party involved. That's a disinterested party, right?
Yeah. Mm-hmm. Let's see. Okay, Shanisha also suggests Everest May or Mutual of Omaha or Gerber for our scenarios.
Yeah, kind of the same ones I said. Someone saying, what did she say?
The options that Shanisha said would be good.
Okay, Mutual of Omaha. Yeah, Everest May, that'd be good. Yeah, it just, again, and that's why I think it's so important you understand is that when we do an analysis on insurance as well, like we got to make sure, does the benefit outweigh the cost, right?
Right.
We got to do that cost analysis to make sure it works in your full plan, right? Because again, sometimes there's other ways that we can make it happen. But just know, like, just insurance gets really expensive the longer that we wait, the way our health, if our health starts to deteriorate. So we got to be careful. I mean, we got to, I guess I'd toggle to myself, right? We got to get up and get out in the gym, right?
Yes, we got to be healthy, guys. Healthy. Healthy. Listen, that's the first step to wealth, y'all.
Come on.
Health.
Yeah. So think about this. So, okay. So with all my technology stuff, one day we're going to get this right. I apologize. I got a new computer, Abby. Yay! So I got remember how Mark was talking about me saying I needed to have a new computer. My computer's going to, or was that you talking about my computer? That was you, huh?
Mark. That was not me.
That was Mark, right? That was Mark. So I got a new computer, right? Set everything up for the show. I got a new camera, got everything done, right? But I did not go back and change my my settings on Google, like my system settings to like, so when you click share, it doesn't allow me to access my screen. So it's telling me that I got to shut down Google Chrome in order for me to share my screen. So I literally had to go back to my old computer and I have my new computer here. So,
and it's okay. Tonight was great to answer all of you guys' questions live. I think tonight was an opportunity to serve you guys live. We can always present to you guys, but I think it's even more important to go over these scenarios and help you guys on them like immediately. So someone asked if you trade. Chris, live trading. Do you trade live, Chris?
Yeah, I do trade. I don't trade live like in a group or a Discord, but I do trade. Every day, at least 2 hours a day, probably. I mean, I allocate 2 hours a day to trading, right? I wouldn't say I trade all 2 hours, or sometimes lately I have to trade in the afternoon versus in the morning. But yeah, I do trade. I do enjoy trading.
Did you get an NVIDIA?
Yes, I got it in NVIDIA, but it's always hindsight 2020. Like it just wasn't enough, right? How do you expect NVIDIA to go up $80 or something a share, right? I mean, that's ridiculous. Somebody should have told me.
What is the email to submit questions?
All right.
We're gonna post that for you.
Perfect. And I do have one of the examples that I wanted to kind of cover tonight. The real life example. I think I'm able to share now since I'm on my new computer. So let's see if I can share this real quick. Let's see if it'll let me do it. Boom, 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 boom. Can y'all see?
Yes.
Oh, look at us. We make right. So we are working. Okay, I'm gonna adjust my screen a little bit to make sure I can see y'all, but y'all can also see my screen. Okay, so this is again a policy example. So if there's anybody, please do. I mean, if y'all are watching the recording, right? If you guys are on live, um, I can't tell you how many times that when you get an insurance policy, make sure you not just listen to the agent, but you also need to understand to the documents, right? Well, I can't even say that because even if people say, Chris, I want to read the policy, like, do you know what you're really reading though, right? So I want you to make sure that you're with the agent that doesn't mind going through the details with you, okay? Going through the policy summary with you. And my goal tonight is kind of give you some things to point out in a policy that you may see, okay? So again, there's multiple different types, especially for people. We've been talking a lot about today about policies that people may be a little bit older, they have medical conditions or those type things, right? But however, if you're in pretty good health and you're speaking with somebody that does insurance, more than likely they're going to be giving you different types of policy. It may be a term. We talked about that, right? You know, again, term is low cost, high coverage insurance. Yes, it's going to last for a certain period of time, but it goes hand in hand with your investment plan. Okay, there's also whole life, there's universal life, there's index universal life, there's multiple different types of policies that say, hey, look, I want to build up cash value. And I think more than anything, especially to nowadays, people want to know, okay, how can I get a policy that's going to build up cash? Or I want to get a cash value policy that I can borrow from, or those type things. Should I get an IUL? Should I get a whole life policy? So my friend, if he watches this, I hope he don't feel bad. You know, again, right? So he was approached of doing a cash value policy, mainly to borrow against infinite banking, that type stuff. And so he was approached with this policy. Okay, so he started. Can y'all see this? Okay, Abby, let me know if you guys, because I can't see. I can hardly see what y'all see.
We can see it.
Okay, cool. So this is an IUL policy.
Mm-hmm.
Okay, so this is an IUL policy. I want to kind of point out the highlights of this real quick. So on this IUL, we have boom, boom, boom. Can y'all? Okay. Face amount of the policy is about $1 million of coverage. Okay. The second thing is also that he's paying initial premiums about $1,500 a month. Okay, because the goal was, hey, Chris, I want to build up cash. I want to borrow from it in the future. I want to be protected. I want to have coverage for a lifetime, right? Mm-hmm. So also look at this. The death benefit option A is so critical. Okay, so this is the first definition when you're looking at a whole life or IUL policy, index universal life policy, a variable life policy. One thing that I want you always to check is the death benefit option. Okay, so that death benefit option comes in two ways, right? It's going to be death benefit option A or death benefit option B. Okay, well, what that means is that in death benefit option A, that means that God forbid somebody were to pass away, you are just going to get the net death benefit that's located in the policy. So do you see how no matter how much money this person's put over $180,000 into this, into this policy illustrated, no matter how much money you put in, no matter what the cash value grows to, again, your death benefit stays the what?
The same.
The same, right? So you don't, if you're doing a policy like this, one big thing is that you don't want to have a death benefit that stays the same. You should have a death benefit that should be increasing. So that is going to be option B that should be inside your illustration. Does that make sense, guys? Y'all follow me so far?
Mm-hmm.
Right? She said yes, understanding level versus the, you got to have that, right? So I know she's going to correct me if I do anything wrong in this on this right?
And that's okay. That's okay.
No, we good. I know. I'm straight, right? The second thing that I want us to understand, okay? So in a policy, okay, let's look at this. In this particular example, they're doing $18,000 a year for this policy. Okay, so one thing that I always go down and look at, okay, so after 10 years, how much did you contribute versus how much is in your accumulated value versus your cash value? We got a lot of definitions to cover, right? Mm-hmm. So this is what I want to look at. So understanding this, my accumulated value, right, is quote unquote kind of like the company's money, your money, but the cash surrender value is your money that if you were to surrender the policy, this is what you would get. Okay, so let's look at it. This policy showing that, okay, the accumulated value is 122,000 versus the cash value is 120,000. So what that means is that there is a 10-year surrender charge on this policy, Abby.
Yep.
There is a 10-year surrender charge on this policy, meaning that those are additional fees that are still going inside this policy for a minimum of 10 years. Okay, again, the fees are going to be ongoing, as I explained it here in a second. But so 10 years, you're going to be paying fees on this, on the surrender charge in this policy. Mm-hmm. See, typically a well-designed IUL or a whole life policy, right, for infinite banking, cash flow banking, you should have a break-even point, Abby, at least after 3 to 4 years. You should have a break-even to where your accumulated value, your cash value should equal within the first 3 to 4. It should not be a huge difference. Okay. That's how you can tell if the agent is pushing more money into the base of the policy versus your paid up additions. Okay, I don't know if I'm getting too deep on this, right? Right. So that's that. I'm trying to go over the easy part stuff tonight. Okay. So let's look at it again. So that's another good key that you got to look at. That's why you got to understand this crap. Okay. But another thing for me, if I'm looking at a policy like this, if I put in 180,000 after 10 years and my cash value is 120, is that a good or a bad, right? I'm not even going to say an investment because it's not an investment. This this policy is not an investment, guys, because you don't even need an investment license to sell it. Okay. You do not need an investment license to sell an IUL policy. So the savings, so what you put into this contract, right? $180,000 and you got a cash value of 120. How would you feel about that, Abby?
When I'm looking at the numbers, you guys know I'm a number person. I'm trying to figure out where's my other $60,000.
Right, exactly. Right. So but then as we continue to go down, right now we have we're over 20 years. We done put in $360,000 inside this policy.
Yep.
Right. My cash value. Let me go back here. Right. No. Okay. I didn't say no license require. I said no investment license require. You do have to have a life insurance license. So again, it's just no investment license required, only insurance license. Okay. Let me go back up and show you this. You guys see how, you see how in year 11, I didn't point this out. I'm sorry. You see how in year 11, you have your accumulated value and your cash value are what?
Are the same.
They're the same. So that's how you know that you're out of surrender. So remember what I said, right? You're a well-designed policy, right?
Yes.
Your well-designed policy should have a break even after 3 to 4 years. I would say 3 years. Okay. Maybe quicker if we use a whole life policy in this example, right? So let's go through it. So now again, going down here, after 20 years, Abby, we're going to put in $360,000 inside this policy, right? And then we would say, hey, look, $264,000 in cash value. So this is one misconception that when people hear online or social media, they say, hey, look, I want to buy a car. I want to buy a home. I want to do those things, right, with my policy. Well, again, if you want to buy a home with your insurance policy, right, you got to have put that much money into the policy to even do it. It's not like you can say, hey, look, I'm going to get this $1 billion policy today and I want to borrow 200 grand from it tomorrow. It doesn't work that way.
Not at all.
Right? So an insurance policy, right, is what you call a tier 1 savings vehicle, right? Again, it's a savings vehicle, right? Or it's what you call a wealth capture account if you're doing it this way. Okay. So let's go down a little bit further. So also in this policy, in this illustration, they say, hey, look, he's going to stop paying policy premiums for this policy after year 27, right? And after year 27, you know how they talk about on social media, online, and all that good stuff. Hey, look, after 27 years of paying this policy at 65 years old, you can get tax-free income for retirement. Don't they say that? So they can say, hey, look, you can get tax-free income for retirement, right? Having a policy. Man, they make it sound so good on social media, guys, right? So this is why you gotta work with people. But okay, so after putting in $486,000 into that daggum thing, right? They can pull out a whopping $22,000 per year, Abby. Tax what?
Tax free.
Abby, you put in
The devil
$486,000
is a liar. Nope.
into the policy after 28 years, 27 years, and you
You
telling me all I can get from tax-free income. They say, hey, look, again, I can be a great salesman, guys. I can be a great salesman and say, hey, look, you can get $22,000 tax-free income for the rest of your what? For the rest of your life. Y'all see this?
all I'm thinking about is how I can put this $486,000 in the S&P 500. I can't get over that.
So this is not a well-designed strategy, right?
Nope.
But again, they're selling it this way. This is why, guys, man, I'm telling y'all, you guys, but you better call me, right? You better email me, right? When you get a policy, if you have a policy like this, you look. I'm gonna break it. I'm not even going over everything right now. But do you guys see at 120, at 120, it says that, hey, look, you would have pulled out over $1.2 million in tax-free dollars.
Yes.
Right? I mean, again, to the average person, that may sound good. You may look at this column here, right? Your cash value. Hold on, let me kind of go back up too. Look at this stuff, right? Your accumulated, like your accumulated value. Check this out. Your accumulated value is like 3.5 million after year 70. Well, hold on, let's do a more realistic example. Hold on. Do y'all understand that? I'm sorry, I may be getting too excited on this stuff, huh? Okay, here we go. Check this out, guys. Check me out. Let's do it realistic. Okay. Look how crazy this is, Abby.
Yeah.
Remember, this column here is your accumulated loan amount. This is your accumulated value, your cash value. Check this out. So after 50 years of paying, or you are having this policy in force, right? It says your accumulated value. Again, accumulated value also means like the company's money, not necessarily your money, right? It's a tricky thing, but we'll go through it again. Right? $1 million. Your cash value is what? 21K. But look at your death benefit column, guys. See, as you use this policy for that tax-free benefit, that whopping 22,000, what happens to your death benefit every single year? What happens, Abby?
It decreases.
It decreases.
Mm-hmm.
Right? So again, so somebody said, hey, I want to have this policy that's going to give me tax-free income, right? It's going to give me a legacy so I can pass on, to my children and leave a legacy. And I want to have this policy whole. Okay. But if you don't understand how these policies work, then you're going to get screwed.
Yeah, that is true.
Right? So the reason why on an IUL, guys, IULs came prominent in the late 80s, early 90s, right? IUL policies, they have their cost of insurance is cheaper in the beginning. Let me actually do a whole nother. I know we're about to run out of time, but I was supposed to do this earlier in my technology. Hold on, let me see that. Okay, let me see if I can change screens real quick, and then we'll be. Am I okay, Abby? You okay?
You good? You're good. You're good. Good stuff.
Let's see. See if I can do this. Okay. So when you're having a policy, let me know if you can hold on.
Yep, we can see it.
I can't see you though. Okay. So if you have I'm just going to go over this IUL, how it works. Mm-hmm. Okay. So when we're looking at an IUL, okay. So typically IUL works like this. So your cost of insurance is going to be, it works like it's going to be cheap in the beginning. Boom. Your death benefit. Boom. Death benefit. Potentially it's supposed to grow up, and then over time it's going to what? Come down, your death benefit. Okay. Then you're going to have, what you also have is your premium. Okay. Your premium payments we'll call this PP, right? Your premium payments. So into this IUL policy, you saw how your premium payments stayed what?
They stayed the same.
They stayed the same. So for most people, they think because they think the premium payment and cost of insurance is the same. It's not. Your premium payment is just what you pay. Mm-hmm. Right. So again, you can say that you have a flat premium payment, that doesn't mean the cost, because what happens, the overall, let me do another color, right? The cost of insurance over time, right? We'll go to CI, cost of insurance. The cost of insurance in the IUL policy goes up every single year as you get older.
Yep.
You see that? So the insurance company looks at two things: the cost of insurance and then your death benefit. Right. So see, those things are in tandem. Just because you're paying X amount of dollars, that doesn't mean anything to the insurance company. Okay. What they look at is the cost of insurance and your death benefit. So that's why you saw on that example that as they got older inside of this poorly designed IUL, the death benefit starts to go down because the cost of insurance goes up. Well, if you're not paying a regular premium every single month for this policy, where's the company going to get the money to pay the premiums for? The cost of insurance. Where are they going to get the money from?
Yeah.
The cash value, the cash value of the policy.
Yeah.
Does that make sense?
Perfect sense.
All right. Please, this. All right. Boom. So talk to me. So this is what I'm going to show this. This is for you, Abby. All right. So you were talking about we did $1,800 a month, and this is why again. I want to do a disclaimer. I'm not saying to do this in lieu. I'm never saying insurance is bad. Okay. I'm a big believer in insurance, right? I think right now I have close to about $7.5 million worth of insurance, I think, something around there. Right. So I like insurance. But at the same time, I don't want my clients to be insurance poor. So that's why we may use a term policy, a level term policy in the beginning, right? Or maybe even forever or throughout their plan. Okay. Because sometimes I feel like people don't understand this is all a puzzle piece that has to be fit together. Okay. Just because the strategy sounds good, that don't mean it fit into your plan. So my biggest thing is before somebody can, I think a whole life or a permanent policy, an IUL policy, cash flow banking, bank of view, that is something that is like one of the last things that you assess once all the buckets are filled up. Once you have a fully funded emergency fund, once you have a great short-term account, once you're fully funding your Roth IRA, you're maxing out your 401k, you're buying real estate, right? You have money saved, right? Like you got to have a plan, guys, before you start spending a crazy amount of money. Because like Abby talked about, if somebody's just, let's say the S&P 500, we'll say a conservative 10%. Is that conservative? That's not conservative enough. We'll say it 8% because somebody's going to check me, right? Well, I'll even say 6%, right? We'll say for 28 years, right? Or 27 years. Is that 27 years? We said $1,500 a month. Am I right?
It was 16.
Yeah. Okay. So yeah. So yeah, $1,500 a month that they're paying for the insurance, right?
It was 16.
$1,600 a month? No, it was 1,500.
Okay, 15.
Yeah, so because it was a 46, remember that?
Yes. Okay, that's fine.
Boom. So think about this, guys. At an 8% rate of return. So my thing is, if you're not saving more money in your investment accounts than you are in your insurance policies, you're doing something wrong. Would you agree with me on Abby?
I agree 100%.
If you're only go ahead, Abby. Go ahead.
Because I'm thinking, okay, if my imbalance, right, is 1.6 million, I was receiving what, $27,000 a month for the rest of my life, right? So if I take 20 extra years, let's just say 27,000 times 20 years, that only gives me 540,000.
Right.
The numbers, the math is not mathing. No, thank you.
So look at it. So that's one of my first keys to help people understand what type of strategy to use. Okay. If somebody is saying, hey, Chris, I'm only saving $250 a month in true investments, but I want to do $500 a month into this, it's a little bit of an imbalance. Okay. Because look at it. At a 8% rate of return over 27 years, right? That 486, that's $1.6 million that you would have in an account. Make sense? I mean, shoots, even if I put it at a 6% rate of return, right? That's still 1.7. I mean, 1.1.
Yep.
So we're saying, well, Chris, but the money in an insurance policy is tax-free. Okay. So let's just keep it real. If we got $1.1 million into an account, we'll say for 40 years, let's say at a 6% rate of return, the money's growing, but I'm doing a withdrawal from my account, right? Let's say I'm just withdrawing $5,000 a month. So instead of having $22,000 a year, Abby, in money, I'm going to get $60,000 of income, but it's good. I'm going to have to pay taxes on some of that money, depending upon what type of account you put it in, if it's an IRA, a Roth, well, shoot, if it's a Roth or something else, well, we couldn't put $1,500 in a Roth. So let me not say that. Let's say if it's a non-qualified account, you may have some long-term capital gains. Make sense?
Mm-hmm.
But capital gains rate, talk to me. The capital gains rate, as we were drawing from an investment account, will be what, Abby?
The maximum I actually see clients is between 8 to 12%.
Come on, right? So if I'm getting $5,000 a month, check this out. That means that they can take out $5,000 a month every single month for 40 years and still have how much money left over, Abby?
Goodness, 1.7.
1.7. So they say, well, Chris, but it's not tax-free. Again, you just told on long-term capital gains on a non-qualified account, it may be anywhere between 8 to 12 to 15% long-term capital gains rate, right?
Yep,
Depending upon where your
cap is 20%.
The cap is 20%, even if it's 20% taxes.
Yep.
Even if it's 20%, you're still beating out the policy.
Yep. And nobody pays 20%.
Come on now. Again, so that's what I'm saying, guys. This is not, so when you're looking at insurance, it's not a either or scenario, right? It's a combination. It's a strategy that has to be put together. Okay. Like that's what I want people to understand is that when you're looking at this stuff, right? When you're looking at this stuff, you got to look at all realms, right? Because again, some insurance agents, they're going to be biased. They're like, oh, well, the market's crashing, or this, look what happened, how much money people lost. They'll give you all the historical horrible things, right? About the market, right? About real estate, because they think the life insurance is the only way to do it.
Yeah.
I'm here to tell you tonight, it's not the only way.
It's not.
It's
just
a part
one
of the way.
Correct. That's
right. We can't get from where we are today to where we want to go. Right. If I'm in Mississippi like I am now, and I want to go to I don't know, Jamaica or something, right? Again, I need to maybe drive from Mississippi to Florida. I can take a car. Does that make sense? But then when I get to Miami and I'm trying to get to Jamaica, I got to get on another boat. So I have to have another vehicle to get me to the next part of my destination.
That is
right.
Mm-hmm.
So I think that's what is so important, what we got to look at when building policies and understanding, okay, how much should I be invested? How much to go to if we want to do a strategy like this, if we need to do it? Because I would honestly say about 95 of the people that are presented plans like this probably may not be in the situation to do it just yet. Does that make sense, Abby? Like there's probably a lot more things that they can focus on.
Yep.
So I hope that, I mean, that's just crazy, isn't it?
Yep.
And you can, again, if you're doing this, and this is like, I'm talking about generational wealth, I mean, that's $60,000, right? So this is for 60 years, they can pull off $5,000 a month and have $3.4 million still left in an account.
Yep.
Hell, I'll even do it. We'll say 5% rate of return. People say, oh, Chris, that's too high. You know what I'm saying? At that point, it would probably run out. Let me see, when does it run out? If we're doing a 5% withdrawal rate, it would run out in about 46 years. I think it would be. Yeah, around 46 years. Right. So if we wanted it to last forever, I would change a true withdrawal rate. If we're doing only assuming a 5% return, I would say probably 3,500 and it would last forever. Oh, right. Potentially. Yeah. Let me, again, on compliance, let me not mess up. Right. Hypothetically on here. Right. You can do this like based on a number. I mean, you know what I'm saying? Y'all see that? Like 100 years. It's like 12.7 mil.
Let's go.
So I hope does that bring some clarity?
Yes, definitely. And it's the beautiful thing about investment, guys, and even in life insurance, the beautiful thing is option. So always review the options and the scenarios and look into what would be in your best interest, what would work for you and your current situation or your future situations.
All right, bro.
Yep. Good stuff.
I think we did okay tonight. Again, sorry for the beginning, guys. I'm gonna make it better.
No problem at all. Great show. Thank you guys so much for showing up tonight. We will see you guys on Wednesday. Don't forget to like, subscribe to the Red Line. Great show, Chris.
Thank you. Good seeing you. You did an amazing job. You know what I'm saying? Look, we a team. We're gonna make it happen.
Yes, sir. Thank you again for joining the Red Line, guys. You guys have a wonderful night.
Good night, guys.